Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, all the way from the city of brotherly love, Dimitri Pargamonik. How you doing, D?
Hey, Will, how's it going?
Good. You want to start with the
Uh,
disclaimer?
yeah, so good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to help answer your questions and provide you and give you advice. So
There you
there's the
go.
disclaimer.
Rob was actually mentioned. A couple numbers came out this morning. I don't know if you caught them before you got into your office, but jobless claims fell, I guess, which can't be good for the Fed not tightening.
Right.
And he also said the Philly factory index is negative for the fourth time in 5 months, which I'm assuming both indicate that inflation is not slowing down, I guess.
I didn't catch that. I was reading something else, but I see where do we like unchanged right now? Maybe we're up a little bit now and changed. Yeah, I don't. The battle with inflation is not going to be easy. I think maybe the assumption is that it will be easy and that the higher interest rates will kind of knock us back into line, and then once that's done, the Fed could go start lowering interest rates again. But I think there are a lot of factors right now in play that are not going to make it easy. And we've been talking about it, and some of it is deglobalization. We're at full employment, but have very low productivity, or not what you would think at full employment. So lots of things in there that I think will be tough, to tame that inflation. Or even if we do, get that inflation down where they want it, they might not have the ability or the luxury to take interest rates back down to 0 or even 2%. So we'll see how that goes. And again, as interest rates go up, we're expecting, or at least, my assumption is that volatility will continue to increase.
Yeah, I mean, and listen, my feeling is, and I know we've talked about this on air and off air, the biggest input cost to inflation, in my opinion, is, the gas pump, right? I mean, people go buy it every day. The numbers are in your face, and it's in my area, it's above $4 again. I can't imagine if I lived in California or something, how I'd be feeling, right? And we're getting into, our brothers, our chameleon brothers from the Midwest, they're already seeing freezing temperatures and snow. And I know it's very cold by me. I haven't been tempted to turn on the heat. I heat with propane. And that first delivery is going to be a mortgage payment, basically. It's really going to affect people's spending habits, which,
and if this is any signal, I think that they're right now talking about increasing the amount of oil that they're going to sell out of the strategic reserves. I think,
yeah, which
15 million barrels per day. And what does that signal to you?
Yeah, I don't want to get political, but it just seems like a scary game they're playing. Rather than trying as a governing body to come up with some sort of plan for how we're going to really bridge to alternative energy. There's no plan with we have an abundance of oil and gas in this country, and there's no long-term plan on how we present that to the marketplace and what we do as a society. It's just doesn't seem like a good plan, releasing that strategic reserve to try to lower prices.
It's not a permanent solution. We've been releasing it. We've been already selling oil out of the strategic reserves, I think like 1 million barrels of oil per day.
No, you've talked about this a lot, and
you're right. So and that maybe as a temporary solution, I could understand if the production needs to catch up to demand, right? And right now they think that demand has to fall. But if they're increasing it, they're looking at the numbers and they're saying that, hey, we can't stop. right? That, and this might be the problem, while they're in there, it's discouraging potential investment in production in energy, because now the government is supplying it, in mass amounts, and nobody wants to get in the way of that, because they're taking the market, lower than where the supply and demand right now at this point would suggest. And by the way, they've already indicated that they would be buyers, because they need to replenish it. They would be buyers of this oil between $67 per barrel and $75, not too far away from here. So now at the same time, if it falls any lower at that point, we have to become consumers. The demand would be increasing to replace that strategic oil. And I think energy is going to be, it's an issue now. And I don't know, maybe December, January, February, come there, at some point, they're going to have to stop selling oil out of the strategic reserves. They're going to run out. Right. And they're there for emergency reasons, not just, just to move the markets around, but really, what are we going to do if there are whatever natural disasters or something, God forbid, worse, that we need to tap into that strategic reserve.
Actually, we just got a chat from Jim in San Diego, and he says it's over $6 a gallon in Southern California.
Yeah,
I mean, that was I would drive off the road if I saw that.
Yeah, and that's, like you said. Well, and the thing to look out for is it's becoming more expensive to make those investments into the development and the research to get to. It's a big capital cost, right, to go in there and get that energy. And if you're artificially depressing that price, and there's talk about windfall taxes and tax on the return on your investments, that's going to contribute to a bigger problem going forward. Because once they're out of the way, where are we going to get that supply? And by the way, Saudi Arabia and the OPEC are cutting. They're going to be cutting the supply right now. So we'll see, but that's going to,
I just heard from our chameleon on the ground in Europe, Laurent, and Chuck was asking, what do you pay? Because for those who don't know, Laurent is a proud owner of a Tesla, and he's brought a lot to the community, talking about how much he loves his Tesla. And anyone who knows a Tesla owner can understand. I mean, people love those cars. So Chuck had asked him, do you even look at gas now? What the gas prices are. And he said it's about $2.15 a liter, which is almost $9 a gallon. If you're filling up in Europe right now.
Yeah, really expensive. So let's take a look.
Actually, he said it's actually lower now because of the currency moves. It used to be like $12 a gallon.
Oh, really?
Yeah.
So, okay. Well, we're benefiting from a strong dollar too, right?
Yeah.
We're right now betting from a strong dollar. The Fed is raising interest rates. That's versus other currencies. That's making our currency stronger. A stronger dollar for us means that our purchasing power on a relative basis is going up. When Europe starts to catch up, I think at some point they'll have to start moving their interest rates up faster. Those benefit, we're not going to see as much benefit as we are seeing right now.
Yeah, it is. I mean, I don't want it to become a political discussion or political show, but it is amazing. I mean, politics and what's going on internationally does obviously affect the flow of capital in the markets, right? And the British Prime Minister, and I am not sure how the whole structure runs in Great Britain, but she resigned today.
Yeah.
Did you see that?
Well,
I mean, she's literally been in office less than a month, I think.
Yeah. I think that when she came in there, she introduced the stimulus package, thought that it was a good idea to stimulate the economy, tax cuts and business stimulus, but they're also in trouble. They've got really high inflation. You can't stimulate demand when you have really high inflation and there's no productivity. War going on in Europe. They got deglobalization. You can't do it right now. When she came out with that package, I don't think she was expecting such a bad reaction in the bond market, and that really shook up the markets. So yeah, she had to. So she resigned today.
Stimulating when you're cutting rates, it doesn't seem like or excuse me, when you're raising rates, doesn't seem like a good plan. And then, in a sense, there may be political fallout here. I mean, you've had a bunch of government, one is actually called the Inflation Reduction Act. That could come back to bite them, politically, because it is, in a sense, there's money being printed, right? It's money flowing into the economy. Whether it does anything to help fight inflation, who knows? But certainly we'll see. But it is money entering the market when we're trying to, slow that money supply.
Yeah, I think analysts think that in the short term doesn't do much either way. To make inflation worse or better. Maybe there are some good things in there with trying to reduce medicine, cost of medicine, but overall, analysts do not believe that that's going to help or hurt either way. It's kind of just you're moving things around. You're reshuffling. Maybe it's more of moving pieces around than creating. It's not creating a lot of demand anywhere or decreasing a lot of demand on a big scale. But yeah, this is not the time for monetary or fiscal stimulus. Not when you have inflation running at 8, 9, or 10% like they have right now down there in England. I think they're like at 10%.
It's high.
Let's do this. We got like 15 minutes left. We'll take a look at the pre-market report. I don't know if there are any questions that were popping up people wanted to talk about today.
No, there were a lot of chat about the price of gas. Obviously, it's something that everyone's got in their, on their mind, tip of their tongue.
Yeah, no, for sure. It's gonna have an impact, but it's not just the price of gas. We have inflation across the board. It's being felt. It's widespread. If it was only oil prices, they would probably let it go because eventually it would resolve itself, right? So if it's only oil prices, markets move around. The demand and supply, the free markets eventually kind of figure it out and put it. It comes back into line, but it's just widespread. We're feeling it everywhere. It's not just oil, it's food and housing and everyone you hear from in the labor market, everywhere it's being felt. And that's the issue. It's a big issue. Let's take a look, Will, what's going on in the pre-market. If you have no questions, maybe I'll move on to Netflix. I think I said we'll talk about Netflix a little bit.
Yeah, you can move right to Netflix. That's perfect.
Okay, we'll do that. So pre-market report. These are stocks trading at pre-market hours. We have the most active stocks, our biggest percentage gainers, biggest percentage decliners. I see 72 stocks made the percentage gainers list, 38 on the decliners. Let me refresh that. I think I brought this up before any of those numbers came out. Let's see if they changed. So 67 on the percentage gainers list, 48 on decliners. So slightly, from this perspective, looks like a little bit more of a bullish bias at the open. Let's look at S&P 500 stocks. If we see a similar situation or something different there, we're going to remove ETFs, leveraged products, closed-end funds, preferreds, only to focus on S&P 500 companies. And to do that, I'm going to use this filter here in ETF. Let's drop it down. And I'm going to select SPY, which is the S&P 500 ETF. When I do that, the list below will get filtered by the holdings in SPY, which are the S&P 500 constituents. And here we see 14 stocks made our percentage gainers list, 10 on the decliners. I would say even there, slightly more towards the bullish side, but pretty much even. Couple earnings that are coming out, notable. Here's the percentage gainers list. IBM, this little E represents that they just reported earnings either yesterday after the market closed or today before we open up, and the stock is trading pre-market hours, most likely to that news. IBM up 4.5%. I think this is AT&T up 3.7%. They reported earnings. Here, Tesla reported earnings, and they're down 6%. I believe that he mentioned that they are seeing a softening in demand, right? Something along those lines. They did have a good quarter, but they did mention, or Elon did mention, that they're saying that demand is hard to come by nowadays. If there are no questions here, Will, maybe we'll move on to Netflix. What do you think?
Perfect.
Okay. Let's take a look at Netflix. And I wanted to look at it from the perspective of when you hear people mention stocks, a lot of times they'll say it is off 50% from their high, or the market's off 25% from its high, whatever it is. And then the assumption is that you're getting it at a 50% discount, right? Oh, well, market's off 23% from its high. Does that mean it's a 23% discount? Does that mean we're getting like this great deal? And in finance, a lot of times you're looking at it not from the price, not from a specific print or the very highest print it ever traded. Is that $799? Does that mean that's the fair price? And today we're getting it at this huge discount. Is somebody just giving us a gift, right? Is this like, what is that, like $430? Is somebody just giving us that gift, right? And we just have to wait for it to go back up. And finance, really, we're not looking at just a price, right? It's not just like, well, what is this? If this is a price and this is a price, that means I'm in discount. A lot of times it's a relative value. And if we start looking at things on a relative basis, then it puts things more in perspective of, is it really a good deal or is it a bad deal? For example, maybe at the time it was $799. The conditions there were so much different than today that it might have been a better deal at that time at 700 than it is today at 270. And that's what we do, is we convert prices to relative valuations, kind of like, what does Warren Buffett say? Price is what you pay, value is what you get. And that's when we kind of have to start putting things more in perspective of, what are we getting today, with Netflix? If you're buying Netflix, what are you getting, and am I comfortable with it? And when we look at a stock, we have a stock price, but what are you buying, right? You're paying this price for Netflix and you're buying a share of Netflix, but what are you really getting for it? Because you're not going to own the entire company, right? So if you're just buying a share, it's not like buying a house. If you outright buy a single home, even if you have a mortgage, you have total control with it. You could live in it, you could rent it, you could renovate it, you could do, wreck it down and build a new house. But here, you're just buying a share and you don't really have much choice. So you're getting something for it, but you don't have a lot of control. So what we want to do is take a look at, on a relative basis, what do we think we're buying? And when you're investing in the company, there are a couple things that you're doing, and really, what are you investing in? What are you're risking for the earnings, right? So the company has earnings, and as a shareholder, you're entitled to that portion of the earnings. And it's not just what it's earning today, but what are you paying for it? You're paying for your expectations of future earnings. So all the earnings that it had in the past, it was already either invested, distributed as dividends, or it'll be in a cash sitting in the bank, and it'll be reflected in its book value. But right now, Netflix is trading 5 times its book value. In reality, what you're doing then is investing in your expectations of its future growth, right? What it's going to earn in the futures, its future growth in its book value, its future, its its future ability to compete. You're investing in the management. All these things you have to kind of take into consideration. Am I getting a good deal? And we're going to just take a look at the basics of it right now. What are we yielding, right? On today, if we took today's earnings and we paid this enterprise value. So today, let me just go here in the summary. Today, the enterprise value is 129 billion. In other words, if you had 129.5 billion dollars sitting in the bank, and you were able to use that to buy all the stock at this price, you would own Netflix outright. It would be yours, and then everything they have in the bank is yours. All the earnings in the future will be yours. It's all yours under your control. And if we just took the earnings from last year, and let's use free cash flow, analysts like free cash flow, because free cash flow is what's available to you after you paid all your expenses. And if we took the free cash flow based on last year, this is the cash return, you would earn 1.1% on your investment. And on a relative basis, that's not really good if we consider that what is the 2-year risk-free treasury, which is guaranteed. What is it, like 4.3%? Right. So if you had 129 billion bucks, you have the ability to put it in treasuries, earn 4.3%, or put it in Netflix, and based on last year's cash flow, that's a 1.1% return. On that basis, it doesn't look that good. Maybe if interest rates were zero, but at 4.2%, that doesn't look good. And if the valuation is this high, that means you need those earnings have to grow. They have to grow to get you above there, or else why would you do it? What is the reason to own, the company? Because you could still subscribe to the service. You don't need to own the company to use their service. The point of owning the company is to get a return on your investment, right? So at 1.1%, it doesn't look like a great deal. That means you need to be able to grow that. That's where you're investing in. The growth in its earnings and its revenue, its assets, its book value, that's really what you're then giving that premium. That's where the premium is coming in. And I'm just going to turn right here to Netflix. This is a letter to their shareholders to give us some insights. And here is their forecast. So this is what they're forecasting. And year-over-year growth for the fourth quarter 2022, they're forecasting 0.9%. And I do think that part of that, they said that was due to certain circumstances, and then it'll start going up. But some of it is due to a strong dollar, there are other mitigating circumstances, but let's just keep that in the back of our mind. Maybe we even say they'll grow at 9%. All right. But this is their forecast here. Operating margin fell significantly. They're forecasting 4.2%, but you could see that, they've had operating margins around 19%. It fluctuates, but their margin is important too, because if you have very low margins, right, you're in a business where you need to do a lot of volume. And if that volume starts falling, you're going to have, or if you see any more compression, or pricing pressure, you could turn negative very quickly. These are decent margins, but that is something you have to consider, right? Now we're considering growth, their ability to earn, what kind of profit margins in there. Their
one thing I heard someone say on CNBC, and don't take this as gospel, but this is what he was saying, is that in the new pricing plan that Netflix has, they could actually, people could drop their pricing tier to take the advertising, and it actually negatively impacts the revenue of Netflix.
Right. There's uncertainty now. And they mentioned themselves that they're in a they're right now in a environment where they're seeing competition. Here it is, right? In competition, they compare themselves to Amazon, Disney, Hulu, Live. Then they mention, other platforms that are competing with them for entertainment and eyes. You got YouTube and social media and Roku, all these. There's competition in the streaming. So we have to consider how their moat. And they do have certain things that are proprietary, like their own content that may be providing a moat, but you continuously have to create new content, right? It's not like Microsoft where, they have an operating system, they make upgrades, but it's very hard to move off that operating system. Netflix, they have to continue to create new content, and they're competing with, Disney and everybody out there, HBO, all those.
Yeah, and content isn't really a moat, right? I mean, there are
It's
other
not a
people who
moat.
compete, and they can
Right.
pull the content away depending on it's like,
Yeah.
when
Right. And exactly. And here's their free cash flow. So you could see jumps around. If we used their free cash flow, and I think that they did give us guidance on the free cash flow, and I'm going to give them the benefit of the doubt. And let's just say they make $500 million a quarter, right, in free cash flow. In a year, that's $2 billion. So that's twice as much as they earned last year. Let's just give them that. At $2 billion, you're still what is your yield on that market cap? Less than 2%. So just to catch up to the 4-year treasury, even if they're growing at 9%, right? Even if they're growing at 9% per year, it's going to take them years before they catch up to that same yield. And those are things, to start considering. And people are going to move this price around a lot, but on a relative basis, we could go back and look like what they were doing back here and what was the competition at the time and so forth. But on a relative basis, I'm just comparing it to the risk-free rate, just to the treasury, what the U.S. government will pay you, to park your money. And for the next 2 years, they're giving you 4.2%. So Netflix, even though they're a great company, and I love Netflix. I use their service. My kids love them. And I'm not going to cancel my Netflix. I'm going to continue using it. But I have to scratch my head and thinking, well, where's this growth going to come from? And I could find companies that are, might be at a much better, yield and margins than Netflix, or I just stay in the S&P 500, which looks better than this, right? So those are like the things things to start considering. I'm not saying Netflix could go up. Look, it could go up, and it could get, the valuations are moving around, and people are looking at it from a lot of different perspectives. Same thing with Tesla or Apple. Everybody's looking at it from different perspectives. I'm just giving you like a short, different viewpoint, that on a relative basis, how do they look? Because you often hear, well, it's 50% below its high. And what does that mean? Because you have to look at what are the circumstances surrounding the company at this point, and what do you think it's going to do going out into the future? All right, we're right at 9:30, Will, so I think I'll just leave it there.
Awesome, D. We did get we were talking about so much this morning in the chat.
Yeah.
Chuck was recommending a series on Netflix, and it sounds interesting because we were talking about Netflix and the moat, which actually, the moat of technology, Rob said, is like smoke. Here for a second, gone in a minute. It doesn't last for long.
And exactly, it's like, how do you certainly Microsoft seems like it has a moat, and Apple does have, it's very hard to break into their businesses. But yeah, you're right. A lot of times people will give a premium for management. If you see management where they're able to grow, they're able to do things that other people competing with them can't do, there'll be a premium for management. And maybe Netflix does deserve that premium. They're able to be profitable. And I'm not sure, according to Netflix, their competition is not profitable. But the competition is still there, and you have to take that into account too. The competition is not going away, and we have to take that into account, right? That competition out of nowhere could come out, and really compress their margins, compress their revenue growth, and so forth.
All right. Awesome job, Dima. As always, you have a great trading day tomorrow. I'll see you on tomorrow, which is Friday. You have a great trading day, everybody.
Thanks, everyone. Stay safe.